I, Silas Mushayavanhu, swear that the evidence that I will give is the truth, the whole truth, and nothing else but the truth. So help me God. I, Joseph Mushayavanhu, swear that the evidence that I will give is the truth, the whole truth, and nothing else. So help me God.
Swear that the evidence that I will give is the truth, the whole truth, and nothing else but the truth. So help me.
I, Christine Chichongo, swear that the evidence that I will give is the truth, the whole truth, and nothing else but the truth, so help me God.
I, Washington Gilbert, swear that the evidence that I will give is the truth, the whole truth, and nothing else but the truth. So help me God.
I, Josephine Takulwa, swear that the evidence that I will give is the truth, the whole truth, and nothing else but the truth, so help me God.
I, Mushayavanhu, swear that the evidence that I will give is the truth, the whole truth, and nothing else but the truth. So help me God.
you take the floor to hear your views. Thank you.
Okay, once again, I think Chairman, allow me to thank you very much for this opportunity that is given. I think the way I'm going to present, I'm going to do it in honest like, can I say 4 parts? First of all, I will talk about the key positives that we see from the mandate statement, raise issues of concern that we have with the mandate statement, and some issues that we think probably will require further attention, and then end with some recommendations of some issues that we think might also help to ensure that we enhance mandate policy effectiveness. So starting with the key positives from the mandate policy statement, the first is the removal of the 5% cap for banks to trade in foreign currency. Probably we can say it was more or less like a clarity on it which the government, because there was banks in understanding that if they buy foreign currency from the central bank, they can only sell it to customers at the official rate plus the 5% margin. So because of that, it was difficult for the price discovery law of the willing buyer, willing seller platform to be obtained. Because the official exchange rate plus the 5% rate was deemed not attractive by most customers who probably would have wanted to sell their ZIC. So we believe that this will positively impact the ability of the willing buyer, willing seller platform to become at least closer to a true market-determined exchange rate. Then, of course, another positive is the tight monetary policy terms. As that I would prefer stability to be prioritized at all costs, and the current wave of stability that we are seeing, which is characterized by a declining parallel market premium, we believe that this is a welcome development. If this wave of stability is sustained going forward, we believe that we are going to see the confidence in ZIC beginning to materialize. Another positive is the attempt to encourage savings. Of course, we know that we not take note of the attempts to increase savings, which we believe that is actually a positive step towards enhancing confidence in the financial sector. However, the 5% interest rate on ZIC savings deposit and the 2.5% interest rate on US savings deposit, we believe this is still lower than the bank charges. Hence, probably they might have some limitations in attracting savings. And of course, another positive is the removal of the trading limits on Forex. There was a limit, a prescribed weekly limit, which one was not supposed to be exceeded by each individual business in terms of access to foreign currency at the willing buyer, willing seller platform. Again, that also had an effect of restricting the availability, the extent to which somebody who is sick but who wants to trade can trade the ZIC. So this removal is also something that is positive, in that we believe it also helps facilitate to ensure that the willing buyer, willing seller platform moves closer to a true market-determined exchange rate. Honorable Chair, there are also some few issues of concern that we have. The first one is the increase in foreign currency retention from 25% to 30%. We actually believe that this is more or less like is considered to be a process of de-dollarization. But we believe that probably the cat has been put before the OCC, in that we have not seen a corresponding announcement which can actually make it more attractive for somebody to hold ZIC. In other words, what it simply means is that there might still be a reluctance to use ZIC, even if exporters are now getting more of it. So we call for a correspondent move, especially from the Minister of Finance, to complement this strategy. For example, if they can declare a certain proportion of pay as UN to be payable in ZIC, so that the recipients of the ZIC from the surrender can easily sell to those looking for it to settle tax obligations. Then another concern from our members is the announcement that only ZIC can be reported, can become a currency of reporting for financial statements our members still believe that it's too early, especially now when there is dominance of USD transactions. Reporting the performance in ZIG might not necessarily be a true reflective of the actual performance on the ground. So as CZI, we are calling for a temporary hold on this implementation until ZIG has at least gained prominence in transactions in comparison to the USD. We also believe that there might still some issues requiring further attention. For example, there is a requirement that every business account should have a POS machine. On one hand, this is okay because it's actually going to be a way of encouraging formalization. But there are some businesses that do not enable direct consumer transactions. For example, consultancies or even a holding company. To say a holding company should have a POS machine when you fully know well that it's never going to be using it. The challenge is that getting a POS machine is some costs involved in it. So our recommendation is that this requirement should be based on a strict KYC, know your customer assessment, no rather than a blanket rule. Then another area which we think requires further attention, the US dollar denominated deposit facility for the additional 5% foreign currency surrender. Yes, so the current announcement is that this 5% you can actually decide to park it at RBZ. In other words, you ask RBZ to hold it for you at no interest rate at all. We recommend that exporters be allowed to offer this 5% to the market rather than to sell it to RBZ, so that at least they can try to get the best available price instead of selling only to RBZ. This will also go a long way in enhancing the performance of the willing buyer, willing seller platform to help determine a true market-driven exchange rate. So some of the recommendations that we believe can enhance monetary policy effectiveness. The first thing is that, of course, we recommend that this tight liquidity needs to be maintained. But it's probably one way of ensuring that the tight liquidity is not causing a constraint in the economy is to reduce the statutory reserve ratios for the USD, so that at least you allow business to continue to lend in USD, because we know that lending in USD is more or less like neutral in terms of money creation. The only problem is if there's too much ZIG in the economy, that's where we are going to see distortions. So we believe that rather than this tight liquidity condition can be maintained, but probably the reserve ratio for USD can be reduced so that more USD can be traded in the economy. Then I'm sure honorable members would know that there was a requirement when the auction was still there. Some companies were not settled to their obligations, but their obligations is now in treasury bills that were given in lieu of these obligations. This dented confidence, especially in the monetary policy. These bills also, in theory, they are tradable, but the bills face a lot of market skepticism, with the banks actually refusing even to discount them. So we are proposing that these treasury bills which companies find themselves in, when they are actually owed by government, can they be structured, especially over a 12-month period, to restore confidence in the instrument? Or you can even allow business to be paid in USD rather than actually through this USD, rather than through treasury bills. Or we can allow business to settle them in lieu of their tax obligations, because government also has tax obligations to meet. Businesses are owed by government, and probably they can allow these treasury bills to be traded. And then the final issue is the de-dollarization roadmap. We see that the tone of the monetary policy statement, some of the measures, they are done as a way towards or to mark the de-dollarization roadmap. But we believe that, especially the tone of the monetary policy statement is to say that by 2030, we're going to transition to a monocurrency ZIG regime. And we believe that there is need for urgent consultations to commence to ensure that there is at least a milestone-based de-dollarization roadmap, So that at least when 2030 comes, it will not be just a sudden, abrupt departure from a multi-currency regime to a ZIG, at a time when probably confidence in the ZIG is still low. So we still believe that if there are milestones announced to say probably our aim is that across the remaining 5 years, each year we aim to increase the dollarization, or to reduce dollarization ratio and increase the dominance of ZIG over USD through a defined roadmap with announced measures that make it attractive for somebody holding ZIG, attractive for somebody to demand ZIG. As we speak at the moment, there are very few companies that have any incentive for looking for ZIG. They are dollarized, the value chain is dollarized, and the ZIG is out there. They are not even coming to the willing buyer, willing seller platform with their USD to exchange for ZIG. So as demand for ZIG, measures that promote demand for ZIG are announced, we are likely to see more people becoming willing sellers of foreign currency at the willing buyer, willing seller platform. So we believe that this roadmap should also have incentives for somebody to sell USD for ZIG. Thank you very much, Honorable Chair.
Thank you, CZI. We have noted your concerns and the recommendations as well. We now move to the next group. Take note that at the end of the presentations, honorable members will pose questions. We also be able to pose questions as well. The Confederation of Zimbabwe Retailers is next.
Thank you, Honorable Chair. I would like to thank you very much for providing this very valued opportunity for the key players in the economy to come and interact with the Parliament of Zimbabwe. I will require or request CZI board member, Mr. Tsek, to come through the brief of the CZI presentation, and followed by 2 or 3 comments from some of the board members why Christine David.
Thank you, Chair. I'll be going into my presentation as a form of a summary, and the President will cover some of the key points. But Chairman, I want to delve into the de-dollarization roadmap and its impact on retailers. Chairman, are the primary instrument which will be very vital in the de-dollarization project, because we basically are the space where ZIG comes and is collected. So we believe that we've got a big role to play. So we believe if a free market approach were adopted, particularly through the liberalization of exchange rate, it will rapidly accelerate de-dollarization cut goods remains readily available in the informal sector suggests that manufacturers prefer selling to this segment rather than formal retailers who are struggling under police constraint. So the core issue is that informal traders operate under different cost structure, making them more flexible and able to adapt to market conditions. So we appreciate the monetary policy is leveling the playing field by the mandating usage of point of sale machines for the informal traders. But however, Mr. Chairman, this may not address the fundamental issues, as retailers are being burdened with the disproportionate restrictions while the informal sector thrives outside these limitations. So we believe if fiscal and monetary authorities work together in a complementary way, that will bring about a broader and a more comprehensive set of incentives and support measures that will support us as retailers. But it should extend beyond us only, but should cover the entire value chain. Retailers, unlike manufacturers, cannot leverage financing models such as the RBZ TFF with the 30% interest rate and the 270-day tenure, as their margins are significantly smaller, especially for wholesalers. So this business model relies on pushing high volumes at low margins, making such financing mechanism ineffective for their needs. So there are some key policy considerations which we believe can assist in addressing these measures. Number one, recognizing retailers' role as intermediaries. Retailers are at the center of economic intermediation between manufacturers and consumers. However, they are not a productive sector and therefore should not be subjected to financial solutions designed for manufacturers and other producers. Policies such as TFF, which are tailored to high margin, longer tenure businesses, are suitable for retailers whose operations depend on high turnover and low profit margins. So we believe that, number two, there should be some incentive that should be extended to the entire value chain. For example, if retailers are to serve as the primary agents for promoting the use of Z, targeted tax incentives must be introduced. That's why we say the fiscal and monetary policy should be working together to create a balanced policy framework to support the whole value chain. Given that the government collects the majority of its revenue in US dollars, the fiscal impact of such incentives would be minimal. However, failing to support retailers will trigger a ripple effect throughout the economy. Manufacturers will become financially strained. I can give you an example, Mr. Chairman, that many manufacturers right now, they're financially constrained because of what's happening at wholesalers and retailers such as in Richards and OK. So the manufacturers are finding it hard to survive, and they're supplying informal traders to get cash to pay salaries. So that's the ripple effect comment one. I'll take it again. However, failing to support retailers will trigger a ripple effect throughout the economy. Manufacturers will become financially strained, leading consumers to shift towards imports from international manufacturers. This trend is already observable and could further erode the government's efforts towards de-dollarization and also destroy local manufacturing. Number three, allowing market-driven adjustments, which is the free marketing I spoke about, or which also says that I spoke about. The market ultimately determines what consumers will use, even if it means paying unreasonable premiums. Instead of enforcing rigid monetary policies, authorities should create an environment where the Z gains preference organically. This requires addressing inflation pressures, ensuring exchange rate stability, and making Z transaction more convenient and attractive to business and consumers alike. Such measures would include tax incentives for retailers accepting ZIG. For example, retailers that conduct specified percentage of the transaction in ZIG should qualify for reduced corporate taxes, VAT rebates, duty exemptions on essential imports. I'll give you an example. I run ethical stores. We import fabric for local production and sell in the retail outlets. If we have got duty exemptions on woven fabric, which is more than 80% cotton, it will allow us to produce more and sell cheaper and collect ZIG through our stores as well and support government policy towards de-dollarization. So, once these tax incentives are put in place, this shifts from coercion to voluntary compliance as retailers will see a tangible financial benefit. ZIG liquidity support. As retailers, we would find that we get produce from local, or our products from local market, and also we import some of the products. So we believe if there is a retailer forex access window at the RBZ where retailers can access forex at interbank rate, provided they process a certain percentage of sales in ZIG, that would be a very good incentive in the de-dollarization project, so that retailers know that if you sell a certain percentage of sales, you've got an incentive where you get foreign currency at interbank rate. This ensures that retailers are not forced into currency mismatches where they collect ZIG but need USD for supplier payments. Mr. Chairman, we've seen this affecting many of the retailers where the suppliers supplied in ZIG and requested the retailers to pay in US dollars. And the retailers are collecting ZIG, which will make it very difficult for the retailers to pay the suppliers in USD when they collected ZIG. So this will be some of the measures which will help in terms of the retailers surviving this environment. In conclusion, the government's current approach to de-dollarize, which relies on us as retailers, is very important. And we believe as retailers, we are key enabler in this. And we believe if we get the right incentives, we should be able to ensure that the de-dollarization project will succeed. Thank you, Mr. Chairman.
Thank you, Confederation of Small Retailers. We now go to the National Chamber of Commerce.
Thank you, Chairman. All protocols, sir. Chairman, I think my colleagues from the Confederation of Zimbabwean Industries and the Confederation of Zimbabwean Retailers have critically outlined the major challenges that we are seeing and obviously aligned to the recently announced monetary policy statement. So, in the interest of time, I am going to buttress on certain points that I think have been made and really just give through or put forward ZNCC policy recommendations. First of all, honorable members, I think we've got to look at our monetary policy. Number one, obviously, the objective being to provide stability in terms of price and in terms of exchange control. However, on the other hand, I think the authorities have also set an aggressive and ambitious growth target for the country's economy at about 6.2%. So it becomes very difficult to achieve that level of growth with a very tight monetary policy. As business, we appreciate this is obviously a scenario where you would say you're between a rock and a hard place. So with the policy rate currently set, the bank policy rate currently set at 35%, and that is also combined with the statutory reserve requirements being at 15 percentage points for local currency and 10 percentage points for foreign currency reserves. This certainly
exacerbates the already tight liquidity situation in the market. So effectively, honorable members, what we are saying is there needs to be a review of the bank policy rate from 35%, our recommendation being 20%. What that does is it still sees the bank policy rate being above the inflation rate. However, it does allow for banks to be able to play the intermediation role in terms of extending credit, much needed credit to business operators. Underlining this point is the need for us to provide liquidity, to provide financial resources for working capital, capital expenditure, which is needed by a number of our members, by a number of businesses. I will then move on to exchange rate policy and liquidity management. The central bank has certainly made measures to try to move towards greater market-driven exchange rate determination. I won't harp at this point. I think my colleagues have already outlined that as business, we are in favor of a market-driven exchange rate. Yes, we appreciate that this cannot be done overnight, and therefore it needs to be underpinned by a very clear de-dollarization roadmap with very clear milestones where the market can move in tandem with the monetary and fiscal authorities in terms of knowing where we are as an economy and where we are as economic agents. I think critically what we've seen is that without that clarity of how and how fast we are moving, all economic agents take positions. Businesses have to plan, and therefore policy uncertainty or lack of policy clarity sees a number of economic agents taking various positions. What we've got to encourage in our economy is confidence, and confidence needs to be underpinned by certainty. So we continue to encourage the Reserve Bank to move towards a market-driven exchange rate, but all we are simply saying is let us have more policy certainty, let us have very clear milestones where the market can also anticipate the direction and the velocity with which we are moving. I'll move on to a very topical matter, which I think my colleagues from the Confederation of Zimbabwean Retailers have touched on quite extensively, which is the issue of formalizing the economy. And I think indeed the retailers and the wholesalers have been hard hit. When we talk about informalization, we tend to focus more on what's been happening in the wholesale and retail space. But I think, honorable members, it's also important to note that by and large, our economy seems to have moved significantly to the informal side of things. Critical sectors, including banking, we were talking here, I think my colleagues were talking about financial intermediation. Because of the tight liquidity situation and other various factors, you are finding that sectors even like banking are becoming informal. I think a number of businesses are having to find alternative sources of funding outside of the formal banking sector. Why? The banks are not lending. And yet in the MPS, we are told that on a daily basis, the market is sitting on a liquidity position of about a billion a second. So our monetary policy has to address issues to do with lack of confidence or the ineffective and inefficient workings of our interbanking system. We've got to look at how we can unlock liquidity and direct it to productive sectors so that we can have our formal businesses being able to access much needed capital in order to enhance their operations. Further to that, through you, Chair, we also believe that legislating the need to formalize the market may not be 100% or may not be the 100% solution. We've got to look at how we incentivize the various economic agents to formalize their businesses. Our concern is that the more we legislate, the more we are pushing players further and further underground. And you tend to find as we engage our members that one of the key issues that business players continue to raise is that the cost of compliance is significantly high. So the more we put in measures that speak to increasing the compliance cost, whether it's by the introduction of point-of-sale machines, whether it's a requirement that before you get licensed, you need to have a point of sale, etc., in place, we are simply exacerbating the situation that has caused most of these players to move from being formal operators in the market to becoming informal. I think we've got to look at how we can incentivize our various economic agents to become more formal. We need to address the barriers to formalization by reducing digital transaction costs and improving the grid and network reliability. I know this is a fiscal matter, but the 2% IMTT tax is still an issue. This is what's causing our market to be largely cash-driven rather than adopting digital technology in terms of the financial services required in our market. My colleagues from CZI particularly pointed out the issue of the export surrender requirements. Again, Chairman, what I would like to point out is the need for us to be able to balance growth-driven policy vis-a-vis trying to maintain price and exchange rate stability. It seems that we are putting our exporters under pressure. The more we expect them to surrender, it means the less access they have to foreign currency, because unfortunately our willing buyer, willing seller system is not working as efficiently. As ZNCC, we are advocating for looking at this problem or this situation from a different lens. How can we, through our policy, be able to encourage growth within our export sector? Because the more we are exporting, the more access we have to foreign currency, and therefore the less we need to depend on increasing the surrender requirements. Indeed, this is part of the de-dollarization framework. However, I still point out my earlier comments, which were we need to have very clear milestones of how we are de-dollarizing. What are our milestones? At what point would we say we are on the positive trajectory towards de-dollarization? So when you then look at some of these policies, as much as we appreciate that they will get us to the promised land, so to speak, but with lack of clarity that has literally characterized our market, you will continue to have different members of the economy speculating. My last comment through you, Chair, would be around regulatory reforms and market confidence. When we look at our situation in our country, Zimbabwe, and the issues that we're dealing with, particularly around price stability, exchange rate, it stems from the lack of confidence in the market. Government does have to take the lead, we believe, and a number of measures have been done by government, a number of measures have been taken by the monetary authorities themselves to try and increase the number of ZIG-denominated transactions, but certainly more has to be done. Our market is lacking in confidence, and therefore, whatever we put forward as policy authorities has to try and ensure that we are moving with the entire market. So certainty, policy certainty is going to be critical. The need to ensure that we've got clear milestones in terms of how we're moving. And I keep talking about milestones, but allow me to point out one issue, for example. If you look at our foreign currency reserves in terms of where we are versus our current account balance, we may not be able to cover 1 month of our foreign currency requirements. And perhaps and potentially we need to grow our reserves to be able to provide at least 6 months cover. But with that clarity of how we're moving towards such objectives and such goals, it enables market players to also be able to assess how we're performing as an economy, and therefore with every policy that is put forward, the market can also be able to read and determine the direction with which we are moving, because we've got those clear milestones, because we've got that certainty, and I believe through that we will have less speculative behavior in our market. Chairman, I thank you. Those are my submissions.
Thank you, ZNCC. Zimbabwe Confederation. Zimbabwe Confederation Zimbabwe.
Thank you, Chairman. I'll try to on two more items that the MCO says there's picked. Overall, the policy statement, Mr. Chairman, is acknowledged as positive because it is consistent with what has been set out as the roadmap. For that score, it is positive. We expected a tight policy, and that's what we got. However, there are downsides to it, which is what I'm going to talk about. But before I go on to the downside, apart from the positives that I think in particular since that I mentioned, I would like just to highlight a very exciting one, where, and I'll quote verbatim, this policy statement regarding the TFF, which is the Targeted Financing Facility. It says, to ensure the effectiveness of the TFF facility in supporting productive sectors, beneficiaries of the funds can access the WBWS interbank foreign exchange market to access the requisite foreign currency upon submitting bona fide invoices to support their critical import requirements. Close quotes. This statement is huge, Mr. Chairman, because before that, borrowed funds were not allowed to be used to access foreign currency. So this is a huge step by the relaxation by the monetary authorities, which should help the productive sectors to access foreign currency in the market. But on the downside, this same statement is, and I think it has already been alluded to, targeting the productive sector only. And we all know that the productive sector requires demand. And demand comes from the retail sector, because the end products really end up in the retail sector. And it is the retail sector that is struggling. So we are saying that statement perhaps is not comprehensive enough. I think some more thought should have been put as to say, how then do we support the demand? If productive sector performs, production increases, then how do we support the demand for the end product? Mr. Chairman, we are also aware that a lot of these discussions also touch on the fiscal side. I think from the colleagues that you have spoken, you have noted a lot of the issues relate more to tax issues, which are on the side of the fiscal side. Even the regulatory compliance costs are really on the other side of the leg. So, as uncles, we are saying perhaps there's need for serious coordination between these two legs, so that one leg, whilst it does what it has done, like we acknowledge that the MPS is rather strong, rather positive, outside those negatives we mentioned, but it's not enough if the other side does not support it. I think CZI called on part of the taxes to be done in zinc, which is really the fiscal side. The regulatory environment is really the other administrative departments of government. So whilst the monetary authorities are probably on the right track, they might just be undone. I don't know whether we could call it lack of coordination, effective coordination between the two legs, so that both policies really speak to each other. Then the last point I would like to mention, outside of everything that has been said, is just to say something more on the 5% increase in the retention. We do acknowledge that because the central bank has lifted the market caps on trading, and as one member here said, the import cover we have is very little. So we can see the central bank try to create more funds to cover the interbank market, since it is really the sole provider, it is really the sole seller of foreign currency in reality. So we can see the rationale of the 5%, but they have said that for now the 5% can be kept in the fixed US dollar fixed deposit. What information lays there is two items. One, we so that the owners of that funds, if they find the rate good on the market, they really do not have to hold it. They don't just have a zig shaft on them when they do not need. So that it really becomes willing buyer, willing seller. So that's in addition to what CZI has said. But otherwise, we think that the monetary policy statement stays the course. It really remained on the direction which has been indicated by authorities. And so we hope that it really achieves. If it succeeds, we know that we've already seen that the foreign exchange market is rather stable over the last 2-3 months. Sometimes even the rates even appreciates. And the parallel market premium is coming down. So hopefully, by remaining consistent like this, sooner or later we can then achieve congruence between these rates, and perhaps the market will really perform as it is. Thank you, sir.
Thank you. First, congratulations. And we have the accountants, and as well get with the accountants, because we definitely over 14 others that we left out by the operatives. I think we can entertain the change of minds now and get these SMEs. But before that, we need to decide what the change of minds based on the SMEs before we go to the charter accountants. So the charter accountants will give us over what we expected. So what we have as what is the same in the conclusion.
Thank you very much, Honorable Chair. Good afternoon, honorable members. I want to take my oath. I, Pardon Jitsuru, swear that the evidence that I will give is the truth, the whole truth, and nothing else but the truth. So help me God. Thank you very much, Honorable Chair. Apologies for coming in late and all protocols observed. We just want to share our observations from the recently announced monetary policy statement. Just like other BMOs here in the House, we note that the monetary policy statement was announced at a time the economy was experiencing, or rather is experiencing, somewhat stability in inflation and exchange rate, and we believe it's reflecting the restrictive monetary policy reforms that RBZ has been implementing over the past 12 months. We also noted that the RBZ is continuing with the same restrictive monetary policy in the new MPS, evidenced by maintaining a high bank rate, accommodation rate, and statutory reserves. We have also noticed an increase in lending rates, which we believe will discourage speculative borrowing, thereby curbing excessive demand supply growth. Just to say that as an industry, we are keen to support government trust in terms of macroeconomic stability, and as the major forex earner, we will continue working closely with government so that we maximize maximize our contribution in terms of foreign currency earnings. The announcement of the monetary policy chair coincided with our engagements with the government to eliminate all structural bottlenecks that are constraining the capacity of the mining industry to maximize its contribution to the economy. I'll just mention a few issues related to fragile power, high cost structure, capital constraints, and specifically for the monetary policy statement, issues related to foreign currency. I just want to add my voice on the issue of reduction in forex retentions for exporters, and to add and say that our members are concerned by the reduction in the retentions. We had an opportunity to make submissions to the governor before they compiled and announced the policy, and we indicated that there has been disproportionate pressure on the retentions on the back of suppliers and some government departments now demanding payments exclusively in foreign currency. And just to say that most mining companies are undertaking expansion projects and some are investing in beneficiation projects. The available foreign currency has become inadequate to meet the requirements of mining companies and potentially leading to the suspension of key projects. And we are concerned as the chamber that some mining companies may revise down their production targets in line with the available foreign currency, and this will definitely impact on the prospects for the mining sector in the outlook. And just to note, the 75% that has been prevailing over the last year was arrived at after accommodating the payment of electricity bills exclusively in foreign currency. In fact, the retention was at 70, and when ZESA demanded payment only in foreign currency, it was increased to 75% to accommodate that demand. Now that the 5% is gone, it means mining companies are now exposed. The model also provided for payment of taxes and statutory obligations in line with the obtaining foreign exchange retention framework. But we have observed some government departments demanding 100% payments in foreign currency. So our computations show that the effective retention has come down to below 45%, which is far below what the mining companies would require for their operations and the capital expenditure. Related to that, the surrender portion is liquidated at the official exchange rate. At a time, mining companies are sourcing local inputs and services at prices indexed at the parallel market rate. So the premium has resulted in loss of value, and the loss of value is on the gross proceeds, so it is akin to an implicit tax that is equivalent to the premium itself. I also want to highlight that mining companies are not allowed to participate as buyers on the willing buyer, willing seller. So those that have shortfalls have no recourse, and therefore the reduction in foreign exchange retentions would directly affect their capacity to import critical inputs for production. The other point is that since most suppliers are now demanding payments in foreign currency, we have seen mining companies experience may build up in zig balances that they are struggling to utilize. Sadly, some outstanding zig balances have been converted into some government instruments that are dominated in zig, and their terms are not very attractive. So as an industry, we continue to call upon government to ensure that the foreign asset framework guarantees adequate forex that meet requirements of mining companies, specifically for importation of critical materials for production. We also appeal for fair compensation on the surrender portion of export proceeds, and by this we mean we are appealing for all the zig equivalent surrender balances. We also appeal for government to revisit the foreign exchange framework, considering that mining companies continue to pay 100% of electricity bills in foreign currency, but the capacity has been reduced. And we propose that maybe electricity bills can be paid in line with foreign currency tensions, as well taxes including royalties, statutory obligations must also be paid in line with foreign exchange tensions. The other point, Chair, that I just want to submit is the directive for entities to report financial statements in ZIG. Our view is that the decision may sort of bring in some complications, including accounting complexities, inflation translation risks, which will bring investor concerns and regulatory challenges. Most of these big corporates have got their parent shareholders outside the country, and for the purposes of matching their financial reports, we believe that we may want to use a hybrid approach where they can report in both currencies, financial statements in US dollars, and then translate the statement into ZIG accounts. Chair, these are our few points that we would want to submit, and I want to end here and maybe entertain questions.
that consumers are always given a few minutes. The monetary policy statement that has been issued at a time when the economy is experiencing relative inflation and exchange rate stability, and credit to the tight monetary policy stance maintained by both the monetary as well as the fiscal authorities. The current monetary policy stance can be traced back to 2024, and we just wanted to say that this is continuing and it is strengthening some of the measures, and we appreciate quite a lot in what was being addressed. I'll try and be very brief to speak to the consumer issues that have been addressed, beginning with the minimum deposit interest rate and promotion of the savings culture. The Consumer Council of Zimbabwe welcomes the positive move taken by the central bank to upward review the minimum deposit rates in order to promote a banking and savings culture which has been eroded in our country. It is pleasing to note that the move will see depositors being rewarded, and it will encourage citizens to bank, thus promoting formalization of the sector. The saving deposits will attract a minimum of 5% and 2.5% up from 3.5 and 1% in the ZIG and US dollar form respectively. Similarly, time deposits will also attract a minimum of 7.5 and 4% up from 5 and 2.5 in ZIG and US. This move will reduce the consumer risk which has been incurred when they keep their earnings at home under the pillows instead of saving with banks. The central bank appreciated that bank charges were high and therefore directed that point of sale transactions for amounts less than $5 or equivalent in the ZIG be exempted from transaction charges for both banking institutions and payment system providers. Such a move will not only encourage consumers to transact electronically, but it will also partly address issues of change in the formal markets, as consumers may start reserving some account balances to meet the small value transactions electronically with no extra charges incurred. Furthermore, Consumer Council of Zimbabwe welcomes the continued stance by the central bank to ensure that banks strictly adhere to a policy compelling them to exempt from bank charges for all accounts that maintain a balance below $100 or equivalent. Such a move is considered very progressive taxing, given that small balance holders are not charged the Such a move is anticipated to hold the closing down of some retail and wholesale shops as we are witnessing on the market. It may also assist in reviving some of the shops that have temporarily closed or are about to close. All this
Thank you.
is good for consumers.
It's good, but a lot of things to say.
I'm left with a few things to say.
Give me one more minute.
The 2025 Monetary Policy Statement also recognized the need to ensure optimal distribution of the signals in the economy, particularly for ease of access in the remote areas and to further entrench financial inclusion. Many people in some parts of our country have never seen the zip, and so as CCZ, we welcome the development and we are ready for more collaboration with the central bank in educational campaigns so that everybody can have access and can be financially included. We have noted that RBZ is also working on enhancing the quality and design of the signals in line with international standards. While the rollout of improved high-quality signals may help to promote the embracement of the local currency, the printing of larger notes is bound to have unintended effects, such as complete shunning away of the old small notes, as we have often experienced as consumers in the past. Retailers, informal traders start to peg their prices against the biggest note, and larger notes are bound to result in the sudden depreciation of the local currency, particularly in the informal market, as this will be followed by the fall of the official rate as the monetary authority attempts to narrow the exchange rate gap. CCZ is of the view that central bank should rather avail more small notes for convenience of change instead of printing bigger denominations. Consumers are being burdened with receiving change in the form of sweets, chocolates, and biscuits, among others. In fact, large transactions can still be conducted in local currency, however, through electronic channels. While the tight monetary policy stance is key to maintaining price, currency, exchange rate stability, it is equally vital to carefully strike a balance between the central bank targets and the economic growth targets. Otherwise, the country risks facing higher unemployment, recessions, and stagflation, which may result in undesired outcomes such as political and social unrest. It is also pleasing to note that 2025 Monetary Policy Statement addressed the predatory lending practices by some microfinance institutions in violation of the Microfinance Act and the Consumer Protection Framework. Unethical and unprofessional loan collection methodologies, over deductions on customers' salaries, and illegal disposal of collateral has been witnessed in the market. This is impacting negatively on the unreserved populations, including the low-income individuals, women, the marginalized communities, and in the end, undermining financial inclusion and destroying all the efforts to financially include everybody. The move taken by the central bank to intensify its surveillance of microfinance institutions to ensure compliance with the Microfinance Act and Consumer Protection Framework is welcomed by CCZ. This is expected to promote financial literacy, economic growth, and poverty reduction. CCZ applauds the central bank on its move to promote widespread establishment of bureau de change operators, especially in the remote and underserved communities, through exempting licensing fees for opening branches in these areas. The requirement for authorized dealers to trade foreign exchange purchased from willing sellers, including the RBZ, at a margin consistent with international practices, is a welcome development as it helps to narrow down the
think there have been a lot of positives and naturally a number of areas of concern that were raised. One of the issues that keeps coming back is that tension between the monetary and fiscal policies. I think one of the issues that continues to come up is the handshake between the monetary and fiscal policies working together on our de-dollarization journey. I think that's been commended, and the policy was a tight monetary policy as expected. And I think we see that with the reduction in inflation and managing of interest rates to do away with speculative borrowing. And this, we'll see the results of this in the narrowing of the exchange rates between the parallel and the official rate. One of the issues that keeps recurring is the retention rates. It seems exporters would prefer to have as much foreign currency as possible. Another area that keeps coming up is around confidence. I think we have the NNCDs, which were non-tradable, and the concerns there around how there was a commitment from government and how it is critical that that commitment be met, because ideally anything from the government should be zero risk, regardless of what the background was. And I think another issue that's critical is around interest substitution, although it's not strictly for this particular policy, but it's a critical topic. And of course, the leveling of the playing field with the POS machines. I think consumers are quite taking with all those measures, and of course, tying it in with the bank charges if we are really going to go digital. If I'm to give a summary share of everything, I think it would be that policy should influence behavior and address the root causes of issues. We cannot legislate certain things, and that ties into what we wanted to speak to in terms of the issue that keeps coming around presentation of accounts in local currency. Please allow me to lecture a bit in a minute. I know we are pressed of time, but we use international financial reporting standards in Zimbabwe, one of 166 countries. And that's very important because we are part of a global village now. And not only that, we don't just use them, but we are leaders in the world. An example is 2 years ago, or 3 actually, we were one of the first countries in the world to adopt new standards when they were issued, ahead of all the leading economies. So certainly we are not just users of these reports, but we are also leaders. And that's important because having such frameworks speaks to the amount of transparency and accountability that we have in the country, which is why you find this now spilling over into the public sector. But coming back to the point, these standards talk about what is presentation and what is functional currency. So we already have guidelines, international guidelines, which we subscribe to. We don't only subscribe to, but we also influence them. As we speak, there are amendments to these standards, which we as well, of course, because they need to speak to us as well in our situations. So having a pronouncement to say that everyone must present their accounts in ZIG naturally caused a lot of anxiety, because the standards provide us with guidance in terms of how we should do it. But I will surprise everyone and say I think it is a welcome move, and we can go ahead and do that, but there are conditions for that. So first of all, I think because these are technical issues, we should be clear that it should be only on presentation currency, and entities must be allowed to follow these international financial reporting standards in order to get to that point. We mustn't legislate the end, but we should simply have a requirement to have accounts presented in local currency, but as guided and following the international financial reporting standards, which will tie into areas around functional currency and so on. So I think that's what we would like to recommend, that we can do it, but we also need to consider issues of timing. There are entities who are releasing their accounts in 2 weeks' time. And I think asking them now to make these changes might be a bit late. However, if we are to continue, then we can allow them to have summarized versions. Let's have abridged versions in local currency, which can be published in the press. But for purposes of AGMs and sharing with foreign investors, foreign lenders, shareholders, I think entities must have the latitude to do whatever they please with that, because remember, these shareholders, lenders, will have their own requirements. They could ask for accounts in ZAR, or they could ask for accounts in US dollars. So for AGMs and other internal purposes, entities should have the latitude to continue doing whatever they want with regards to the currency. Perhaps so publication in the press is we can desensitize the public with our currency receipt. We can have them convert those figures using the International Financial Reporting Standards and publish them, but they have to be abridged versions, which should be for public consumption. But foreign lenders, creditors, shareholders, AGMs, I think entities must be allowed to make the choice over with regards to how they are going to present. And also to get clarity on defects, whether entities and the defects are also expected to present in local currency because they've got their own requirements and it's a foreign denominated exchange. So I think there's also need for clarity when it comes to the defects. And I think, Mr. Chair, I try to be as brief as possible, but I think that's our presentation from the Institute of Chartered Accountants. Thank you.
Thank you very much. Questions? On my side, I think I have a question for the CZ guy. You talked about the trade reviews. I wanted to ask you, what is really the problem? Are you failing to dispose of trade reviews? And if you are failing to dispose of trade reviews, what is the recommendation? You want a high-tech feature of the trade reviews? You want to resell them back to government? You need to be very clear on that. And also, we need to know how much in trade reviews is the industry holding, or are the individual companies holding at the present moment in the United States, so that we can really estimate as to the possibility of the government actually intervening in the trade reviews. There's someone who talked about the air shares in the market. I think this is the Confederation of Zimbabwe Retailers. There has been a speculation of maybe perception that retailers are actually engaging in artificial shortages. We need to address this. And we not engage in artificial shortages. There's also an issue of free-tire pricing, where some retailers are only required to be paid in United States dollars. And if you go there with your Zip, they will simply tell you that your machines are not good. There's no network. I'm sure even food outlets will do this. What is your plan to address this? This is really affecting consumers. You talked of a free market, of course. What you are saying, you want the ZIC to gain preference using market factors. So, are we ready for an uncontrolled market? If we are ready, are we really guaranteed that industry retailers will behave? If they are not regulated, if they are actually regulated. Then there's LXCC, the possible interest rates. I think interest rates that are lower than the inflation rate would actually cause a speculative event and actually fuel arbitrage and activate more the power market. You said you wanted a lending rate of, or a rate policy rate of 20%. Is this not going to encourage speculative or people trading money for the government wanted to cure that problem? What is your response? And there's also some cell boxes by banks. What would be encouraging this? Cell boxes, companies going to bank in their money in cell boxes. I'm sure there was a problem raining, and this period is since going into it's now forgotten. We don't expect the resident to raid foreign currency accounts. What's the need for these safe boxes? We are told that there are huge amounts of foreign currency lying idle in those safe boxes. So we actually think that it's now more of speculation than reality. Then there's the Chamber of Mines. But most of the companies which are involved in mining, of course, we are the highest foreign currency earner. But most of these companies are foreign owned. What measures have you put in place to ensure that these funds which we receive are able to assist with our economic recovery efforts? Because if these monies just come and go, we also have some Chinese companies who are not even getting the money for. But when the money comes, the money is not in the formal payment system. A lot of illicit exportations of precious metals or minerals. How can this be addressed in view of the current monetary policy that the government is presenting? I'm sure you noted the SMEs, you noted the point of sell machines. You say this is a way of promoting financial inclusion. I think we agree there. Who else? The chartered accountants. The financial reporting. You said it's possible. But your fellow corporates are saying it's not possible. The industry players, we don't do it. The reason why it's not possible. Because you can simply convert as an exchange. Even if you have investors, they know that it was so many billions in ZIG, the exchange rate was so much, and they know that it's how much in these dollars. So I'm sure the government has done this to ensure that we continue to rely on the ZIG as our anchor currency, and we promote the use of ZIG as well, not only in transactions but also in reporting. So I want to open this up to the honorable members to also pose their questions. Who is ready? Honorable, are you ready? Yes.
Yes, thank you, Chairperson. Thank you to all the presenters. I think they did a very good job. A lot of the issues that have raised a lot of times on the market. My point of clarification is with regard to the Chamber of Mines. I heard that they are not allowed to trade or they're not allowed to participate in the foreign exchange market. I want to confirm what the reasons, why is it that associations like that, yet they also contribute to society. Then, lastly, I'm sure the issue of the two-tier price system, where we have the black market and the small market, is a major issue in this regard. Maybe is there anyone who is with the current guidelines, the RBCT forex trading guidelines, to regards to the authorized tiers? I think it's very important because it is very scarce as time. To what extent is our exchange market-based, or to what extent is this too uncontrolled? Is this too controlled? What we expect a fully regulated trade. Thank you.
Thank you, Honorable. I think we're going to give you time to respond because we want to questions. This is in response to your questions, why some of the members are preparing more questions.
Okay, thank you very much, Honorable Chair, for your question. Yes, the general gist of the meeting that our members are struggling to discuss the treasury bills. Remember, the treasury bills came as a result of owings from business. They were expecting to receive USD for working capital purchases, but now the treasury bills. And unfortunately, banks also, more or less like everyone let's undo treasury bills and just give the business the foreign currency that they were supposed to get in the first place. Or alternatively, since the government is the underwriter, let the government accept these treasury bills. Business is willing to use those treasury bills to settle whatever they are owed to government, which includes tax obligation. So probably now, not even the market does not want these treasury bills. Why does the government probably should allow businesses to use that to settle their smaller obligations? Those are our two recommendations on that.
Thank you. Next one,
Thank you, Chair. If I noted the questions correctly, I think the first question posed was around the bank policy rate and our recommendation of reducing it from 35% to 20%, and the concern that this may drive speculative borrowing, which was one of the primary motives of such a bank policy rate. Honourable Chairman, I would like to draw your attention to what I would say our research has alluded to, and therefore our recommendation. If we were to look at the January 2025 ZIG month-on-month inflation rate, it surged to 10.5%, up from 3.67% in December 2024. Then the US dollar inflation spiked from 0.63% to 11.5%, which basically pushed the weighted inflation rate to 11.57%. But when you then dig deeper, our findings show that yes, indeed, obviously this shows widespread price pressures with housing, water and electricity costs surging by 30.66%, food prices rising by 6.85%, and communication services increasing by 7.92%. And all these are partially driven, or should I say significantly driven, by regulatory burdens and an increase in administrative prices. So if you then look at the pressure that is coming onto the pricing framework for a lot of businesses, a lot of it we are saying is attributed more to compliance requirements and regulatory requirements. So when we are then putting forward a reduction of the bank policy rate from 35% to 20%, we are acknowledging that the inflation, the bank policy accommodation rate has to be above inflation, which, as we've indicated, is around 11.57%, if we are recommending it at 20%. Further to that, we are saying that which is driving inflation now, we are seeing it not necessarily being a function of speculative behavior, but what we alluded to earlier, that we've got to look at our regulatory and compliance costs, which is certainly posing a challenge on the ease of doing business and increasing the cost of doing business. It is a tightrope, Honourable Chair, we acknowledge that, but we are also saying that by reducing the bank policy rate to 20%, it is giving a bit more breathing room for players in industry and commerce to be able to access relatively more affordable financing by reducing that cost. Then if I'm to attempt the second question, which is an interesting one, Chairman, around safety boxes, and don't know if I'm necessarily qualified to make an overall comment, but let me comment nonetheless, because I did allude to the informalizing of sectors in general, and I think this issue of safety boxes may be evidence of some degree of informalization. Now, safety boxes have always been there. Custodial services have been provided by our financial institutions. So the need and the reasoning from them is not the issue. But I think we are seeing an increase in the demand and in the usage of safety boxes because of the ineffective intermediation function that is prevailing in our market. Honourable Chair, number one, we are saying that our market has become largely cash-driven. There is hardly any incentive for economic players to be banking their funds. And I think this is widespread, not only from business, but even the consumers themselves. And I think our monetary authorities have to look at how our financial services providers are operating in the market as far as banking charges are concerned, transactional charges are concerned, and therefore look at what is driving people to prefer to hold cash than to put it into the formal banking system. I think in addition to that, it is about confidence and access to liquidity. Where safety boxes in the past would have ordinarily been kept to warehouse important documents, etc. Yes, we are finding that more cash is going into these safety boxes. But I think the underlying cause is the fact that we are not encouraging formal players by way of incentivization to be using the formal channels. Rather, you'd find that economic agents are choosing to have their cash readily available when they need to transact, because if they take it to the bank, they are then met with limits on how much they can take at any given point in time. They are faced with charges, and these are the drivers.
That was amounting to subverting the banking system. Because if you are keeping your own money, the banking system does not have access to it. The billion would be making a lot of money. Maybe equivalent to what you see the difference. Delta making huge sums of money and keeping that money in a safe box. No other person has got access to that money. So I'm sure this is something we need to address, all of us, to ensure that we get rid of these kinds of practices, because obviously it is going to affect our financial stability, access to funding, interbank trade, and so on. But your points are very valid. We are here, we are taking note as honorable members. We will make recommendations, of course. But what was the recommendation? We are saying it must continue, or you are saying maybe it must. I didn't hear your recommendation as to what we can do with safe boxes. Because some of the industry players who are doing it.
Honorable Chair, in my submission, we had no recommendation for safety boxes, but I was responding to your question. However, I do think that what we've got to deal with is the ineffective financial intermediation in our financial services. Rather than regulate, let's incentivize. Let's incentivize, and it's not only business, but I think all stakeholders critically, to be incentivized to bank, to be incentivized to use the formal financial services channels in terms of their transactions.
three-tier pricing model again is also informed by the dollarization of most centers. You may appreciate your chair that fuel largely remains in US dollars, and yet there are power challenges that most players have faced, and they've got to be required again to power their entities or generator. So generator power is required and they require USDs to procure the fuel. And also the real estate. Honorable Chair, we also appreciate that most vendors, whether it's domestic and commercial level, there isn't any entry in this kind of accepted vendors in the city. They are there, they fuel. So it is also one area that we believe that climate change also help us in order to have inflation. And the issue of the informal sector, the economy, just like our colleagues have indicated, is highly informalized. And we believe that in an aggressive approach, in the right approach, we need to actually create incentives for our informal sector, because already it is a part of the distribution chain that we cannot ignore or push away. Instead, there's been a lot of them coming up through the power program of the government, and retail also is actually easy to start up. And we acknowledge that a lot of the business models are actually trooped into the sector. So what we believe is that in terms of taxation, I think it is one of the key issues that they have raised is an issue that inhibits them from formalizing. So it has been our core approach that a favorable preservative taxation model can actually work to attract them to formalize. Even if you come up with some team number system for each one of them, I think that can also progress. Other than for us to aggressively pursue that the economy may actually be the but for the formalized players, the core is being leveled up the playing field. The regulatory centers on that chair are quite many. I've got a list of regulatory compliance centers that the formalized business is got to meet, and I think it is in the report that I've submitted through the secretariat. There are quite many, and they need to be similar. I'm happy, Honorable Chair, that His Excellency President actually gave the policy direction by requesting and requiring that these regulatory and compliance centers that have become a cost must be acted upon. I believe it is now a matter of implementation where some of them must actually be streamlined. Thank you. I should also highlight that occasionally falls under retailers associations. We have professionals, but any retailers, Spark, Danish, editors, and many others actually fall under the association. At this juncture, I request Comrade Ashido, who is the director for images, to probably come through with some innovations.
Thank you, Chair. In terms of challenges, I think you will appreciate that a lot of challenges have been articulated this afternoon. I would just highlight the issues that have affected us once again. Possibly one is exchange rate management in terms of the disparities in passport exchange rates that we had in the economy over the past 18 months to 24 months. Yes, there's stability now in the past 2 months, and we are very appreciative of that. And we hope that it lasts maximum, if you've got all departments, I think you're getting to something like 30. The number of tax heads that we have to pay in comparison to our colleagues in the informal sector, we are advocating once again to say perhaps we can have more players in the economy, formal and informal, paying tax rather than just a few players paying more tax. We have more players paying less tax each rather than a few players paying all of the tax. We are excited that His Excellency has mentioned the ease of doing business, and we believe that process will, in a structured way, address some of the challenges that we are facing in terms of regulation. We are not against regulation, we are against over-regulation. Informality, of course, is an issue that has been affecting us. I'm in agreement with colleagues who are saying that we need incentives for informal to informalize. At the moment, as they see formal players that have been around for a long time in trouble and closing branches and whatnot, that doesn't bode well for the shift from informality to formality. It discourages those nascent businesses from formalizing and growing. We need to kind of incubate those informal players and grow them into large corporations. I think they are those that are entrepreneurial within those ranks who can grow. But we will not get this growth as long as they do not see the benefit of being formal. So incentive is important. I think that's what I will submit at the moment.
There was something about some installation of some sort. You can say your structure is too heavy, and maybe you cannot cooperate in a dynamic environment.
Okay, in terms of risk management, it's difficult to answer on behalf of these internal matters for each business. It's suffice to say that if you look at the sector as a whole, there's distress across the board, but the ownership structures that we have listed companies, we have family-owned businesses, we have owner-managed businesses, and across all of these, we have international retailers that have come in, that have left. Across all of these formats, you are seeing distress and you're seeing reduction of shelves of trading space, you're seeing closure of branches, you're seeing others wanting to close outright. So, by virtue of that, I would not be convinced that it's mismanagement across the board in the whole sector. Also, if you look at the linkages that our sector has with the rest of the economy, you will notice that manufacturers are expressing concern with the closure of retailers. You will notice that banks tend to depend on daily bankings that are done by the formal sector, and they're facing challenges from that. So I think we need not isolate the challenges that the retail sector are facing, but treat them as perhaps a symptom that requires us to start asking why until we get to the source of the problem. And the source of that problem across the sector of the retail sector, I would posit that it is the environmental factors that have been described here, exchange rate management, interest rates, and all of those.
Yes, the question was something to say.
Something to say.
I think that was the question.
My name is Vincent Chikwana. I've won a lessons in branch. I don't know most of this processing of universities who is trust and part of the retail chain. I also run a grocery shops in tourism. There's only we share to share some difficulties that we are facing in the retail business, particularly the banking sector. We cannot access, we can't even bank in our proceeds ourselves to the day why everything that is coming to our doorstep is cash to them. Be it service, be it program, be it legacy, be it Belgium. Despite the fact that we could cross machines, we are having USD in our accounts, but we don't access it from our providers. So hence, this is one of the problems why the informal sector is not placing their money in the bank. Not only that, most of the companies are opting for cash.
sold or trade for dollar. Then when you are about to purchase that one, there is the text that comes out first of that dollar. And when you want to purchase again, it's made for